Here in this video, we're going to be going over what's coming next for AMC stock, what happened today in our markets, what Wall Street and financial institutions and the Fed is saying about this latest CPI report. Hit the like button as well as subscribe to the channel if this interests you. AMC stock down over 3% today. Not particularly a fantastic day for AMC. That's because CPI came in a little bit hotter than expected. There's very mixed opinions on this. Some people say this looks like inflation is stalling. Some people say, well, this is exactly what we expected. It's housing. It's core services. Mainly housing, though. So there's a lot of various opinions. Stocks recovered from the lows today. I think that's a good sign that, the situation's not all bad, right? So we'll see. Obviously, the situation can change and it will change, but that's as of right now. It seems like the story on Wall Street changes every single day. Let's take a look at what Fed Master just said. Fed Master says on inflation, we need to see housing and goods price pressures continue to move down. She also made a couple other statements. She says, December CPI shows the job isn't done yet. Yikes. She says, March is too early for me for a rate cut. I think we need to see more evidence. She also says, we won't get to 2% target this year. Not exactly great talk from the Fed, okay? Not that good at all. Now, as I shared in the last video, Warren Pies says this report on CPI changes nothing. 98% of core CPI increases came from shelter. 69% of that, came from services. 69% of that came from shelter. Shelter starts biting hard this spring. I don't know, what he is suggesting, causes shelter to fall. I know there is huge lags with rent inflation. So that's obviously something that hopefully will start to help, but I'm not as confident that it's just going to start plummeting all of a sudden. And a little bit of good news for stocks. Goldman Sachs says the bar for Q4 earnings is too low, and there is some upside FOMO behavior, given net exposure is not long enough into these prints. This is important. Is the consensus too conservative? So he's basically saying, one, consensus might be too conservative, right? We're expecting slower growth than Q3, really slower growth than all of 2023 in Q4, right? Or the slowest growth in over a year, essentially, is what they're saying here. And that could be too low. That does make some sense. But the bigger point is people are not long enough into a potential positive market, right? That does give us surprises on earnings. And that's true. You still do have $6.2 trillion sitting in money market funds that stands to, see their yields fall over the coming years. So what does this mean? Well, if you're in money market funds, that's investable capital, right? That's not money in people's bank accounts. That's not going to get invested. This is already invested money. $6.2 trillion that otherwise may have been in stocks. That's not. Now, we're going to get new numbers for this here shortly, and it's probably going to show at least some form of an increase, right? We've already reported that, but you did see some of the largest inflows to money market funds here just over the past 2 weeks or so. At the same time, stocks have been going higher, which is, pretty interesting. At some point, you will start to see this money go back into stocks. This will happen either because the economy does well in 2024 and or inflation comes down, or the Fed starts cutting rates. When the Fed starts cutting rates, they're going to see likely a lot of this money come out of money market funds into interest rate sensitive sectors of our markets that will benefit from that. At least that's my expectation, right? That's, I think, a pretty logical expectation. Now, there is a lot of bad charts as well that we'll look at too. The Game of Trades says a big spike in this indicator has ended in recessions since 1995. Job losses have been accelerating aggressively. This is not looking good. This is permanent job losses. So permanent job losses are starting to rise. What's actually interesting is permanent job losses in the past, well, they tend to only start really rising like this, like where we are now, either in this case right before a recession, like 08, 09, or during a recession. So the fact that you're seeing permanent jobs being lost, very, I guess, strange that we're not already in a recession based on, what we're seeing here. That would suggest that, maybe we are in a recession after all. I don't know. I'm starting to question things a little bit. Now, Liz Young says headline and core CPI year-over-year rates of 3.4 and 3.9%, respectively, above consensus. Disinflation progress has stalled a bit, with both shelter and core services ex-shelter contributing double the pre-pandemic baseline. So if you look at this, the consumer price index, food inflation, basically gone. Energy, no inflation. Core goods, no inflation. Core services ex-shelter, little bit of inflation there, which is kind of in line with what you've seen throughout 2022. We're not really seeing any big jump there. All of the inflation is essentially in shelter. Yeah, so that is really the deciding factor. Now, when you actually think about this logically, when did we start getting most of the shelter inflation, right? When did that actually happen? 2022. What happened at the same time? Well, the Fed started raising rates. In a very strange way, you wouldn't expect this. Maybe the Fed cutting rates actually pushes shelter inflation down, as it will be cheaper for people to get mortgages. It will be cheaper for people to refinance and have cheaper monthly payments. Maybe that translates into a cheaply rent payment or cheaper rent payment. I don't know. That's what the chart would suggest to me. So I think that's worth kind of diving into a little bit, because what you'll notice is, again, the shelter really didn't start seeing a lot of inflation until, well, the Fed started raising rates, which is kind of crazy. So yeah, a little bit of a hot take there. Now, again, Liz Ann Saunders reports the CPI categories, and this is headline. So on your headline, electricity was the largest gainer, 1.3% month over month. Airline fare, 1%. Meats, poultry, fish, and eggs, 0.5%. Hospital services, 0.5%. Used cars and trucks, 0.5%. Rent of primary residence, up 0.4%. Owner's equivalent rent, up 0.5%. And everything else was pretty minimal. That's where you get 0.3% for your headline CPI month over month. Fuel oil fell 5.5%. Natural gas fell about 0.5%. Vehicle repair and maintenance fell 1/3 and fruits and vegetables fell 0.1%. If you look at CPI select targets or select categories year over year change, motor vehicle maintenance and repair up 7.1%. Rent of primary residence up 6.5%. Owner's equivalent rent up 6.3%. Hospital services 5.5%. Food away from home 5.2%. All items up 3.4%. And then you have some deflationary pressures here: gasoline, airline fare, natural gas, fuel, oil, dairy and related products, and meats, poultry, fish, and eggs. So yeah, there's definitely some inflation out there still, but what I'm actually hearing out there is this is pretty expected, right? This is not a terrible sign. It says Deutsche Red Sea attacks serve as a reminder that it can only take one shock to throw the disinflation path off course. Clearly, if the current situation is resolved, then it could reverse quickly again, saying that some of that pressure on, some of inflation could come because of, well, the Red Sea situation. Not exactly great. Game of Trades shares this as well. I think in context to what we've talked about here in this video so far, this is very interesting. He says home prices are contracting sharply. These levels were seen in two times, 1970 and 2008. Both ended in sharp economic downturns. You can see the yearly percentage change in median sales price of houses sold for the United States. You're down about 7 or 8%. Which is falling pretty aggressively. And this just makes you wonder, when does this feed into CPI? When does that help CPI to come down? I don't really know, right? It's not great. He also says the yield curve is steepening from inverted levels. This brings the economy closer to an economic downturn. This won't end well. And that's pretty much it, right? You're the most inverted since the 80s. This is one of those things which is really more a sign of Fed policy more than anything else. I hate when people use the yield curve as some, all-seeing indicator that you're going to go through a deep recession, or that you have to go through a recession. All it is a reflection of Fed policy, right? Because if that were true, why wasn't 07, 08 a larger inversion? It's all based on Fed policy and how aggressive the Fed is raising rates. Back during, 04, 05 to 2008, the Fed was raising rates very slowly and meticulously, not straight up like they did over the past 18 months. So the yield curve didn't go as inverted. It's same thing with the 80s, right? The Fed went aggressively, quickly to raise rates. Yield curve went very inverted quickly. Same thing now. It's the yield curve is only a reflection of Fed policy. It's not a reflection of the economy and what's going on in the economy. It's just not, okay? So you don't always have to see a recession just because the yield curve went inverted. That doesn't make a whole lot of sense. And if you want to get very kind of logical to that point, you've only seen a recession in recessions in recent times with catalyst, right? I don't think inflation's a catalyst at this point to push us into a recession. It's just not. We've probably been in a recession the last 2 years in the grand scope of things. But in the last 20 odd years, 24 years, you've had a dot-com bubble. That was because people were investing their money into terrible companies that went bankrupt. Everyone lost almost everything, especially if you were retail. You seen huge losses. That's a big catalyst right there. Then you have the great financial crisis, banks going basically under and people laying people off. Credit really collapsed. It was very hard to get hands on any kind of credit during that time. And then what do you have? The Rona. That was very short-lived. Another catalyst. If we go into recession this time, what is the catalyst that causes that? That's the part that I really have a problem with, is where's the catalyst? What's the catalyst going to be? It could have been the banking crisis back in the beginning of 2023 that lasted for a whole 5 minutes. And then the Fed, printed $400 billion onto their balance sheet and boom, crisis averted. I don't know what else causes that, right? We've seen the Fed, in 2023, we've seen that the Fed, they're going to do whatever the hell they have to do to make sure the economy avoids a recession at all costs. That's it. That's factual. We've seen that with the banking crisis. The Fed did not hesitate to inject $400 billion into the markets. So When I think about all of this in context of the CPI report that we just got, it's hard to draw any definitive conclusions because the inflation is still in the same areas that it has been. We still know inflation works with a lag. Markets today, IWM down 1.25%, the S&P down 1/3 of 1%. Small caps definitely underperforming. That's somewhat as to be expected. You are bouncing off of the gap. All gaps must be filled. Well, we filled the gap today on IWM. So maybe that does allow us to make a turn higher here. I don't know, though. I'm not confident in that. I think even if we do make a turn here, AMC stock is still in a little bit of trouble. And I think AMC stock will be in a bit of trouble until we get a commitment to not diluting shareholders. If Adam Aron wants to, he'll come out tomorrow and raise capital, and AMC stock will fall to a $2, $3 stock. Could happen. If Adam Aron does not want to see AMC stock go higher, he's not going to make the stock go higher. Now, you do have short interest off your float at 9.23%, $114 million worth of short positions. Days to cover 1.15, 23.14 million shares currently sold short, 17.82 million shares currently out on loan. Cost to borrow 1.07%, utilization about 31%, short score of 54.71 out of 100. Cost to borrow max at 8.6%, cost to borrow minimum 0.86%, and cost to borrow average 1.39%. If we take a look at the option activity here on the day today, you have seen about 6 orders totaling $309,000 with a positive order value of 0%. Call activity or volume activity to the call side, 66.31%. Put activity 31.06% here on the day today. So not terrible numbers, but again, there's just not much you can do on a day like today. If we take a look at the stock twits gauge that I have been looking at for AMC, you are at extremely high message volume, 84, and the sentiment continues to be extremely bearish at 1. So that's not too great. The action's really going to be in next week. Hopefully by then we're over this CPI crap we got today. We'll see. Next week's going to be all of the action. You got about 1,500 calls currently in the money, 228,000 calls out the money, 91,000 puts in the money, and 47,000 puts that are out the money. So definitely could see a lot of activity there coming next week. Let's see if we have a new AI investor sentiment survey, and we do. 48.6% of investors are bullish, 27.2% of investors are neutral, and 24.2% of investors are bearish. So not much has changed here. Bulls stayed the same. Neutral investors dropped from 27.9% to 27.2%, and bearish investors increased the difference of neutral. That is very strange. The surveys look almost identical here. Yeah, very, very strange. I've never seen a week over week survey look like that. Considering we had a lot of weakness as well, you would think the bears would have really started to pick up a little bit more, but that just did not happen. If we take a look at 10-year treasury yields on the day today, let's see. It appears 10-year treasury yields really not doing much of anything, kind of trading sideways, which shows this inflation report is probably not changing anything, right? It's probably not changing Fed policy. At least that's what bond investors are telling us. Hit the like button and subscribe to the channel. Let me know what you think about all of this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.